All right. Welcome, welcome, everyone. Happy Monday. Hope you all are doing well. We are kicking off intro to angel investing shortly. I'll wait just a few, well, maybe not a few minutes, maybe about 30 seconds before getting started. But if you are tuning in live, please let me know in the chat what's going on. John Carlos, thank you for joining. I am excited to get things started very shortly. And I think we will have a great time together. So throughout today's session and then future sessions, of course, as well, feel free to drop any questions or comments in the chat. I'll be going through a series of different slides, but absolutely want to have a bit of a conversation wherever possible and make sure that I'm answering any and all questions that our community of learners have. So with that, we'll wait just 30 more seconds and then go ahead and get started. All right. So with this course, as I'll break down in a few slides, this is a live course. I have several live sessions I'll be hosting, and then we have a community of others who at any point in time can watch the replay on demand. So whether you're watching it live or watching the recording, thank you for tuning in. I hope you find value in the content. So let's go ahead and get started. So again, this is Introduction to Angel Investing. This is a new course provided by Bison Venture Partners. We have been slowly and steadily building a really diverse community of investors and entrepreneurs, a lot of individuals who are really just getting their start in this venture space, whether as a founder or as an investor. And the really cool thing about what we're up to is we want to build a community where we help everyday people in our community understand that you can also have a seat at the table. You don't have to just sit back and think that venture and startups and investing in startups is only reserved for people who are venture capitalists in their full time, or individuals who run private equity firms, or simply for wealthy individuals. We want to make sure that we break down the barriers, create some accessible opportunities, and share resources and the knowledge that we've accumulated to help others understand that they can be a part of this space as well. So today, I'm going to be covering the first two parts of our course. The first being understanding your why, and then the second being all about knowing the rules and regulations when it comes to investing in startups. So before I get too ahead of myself, let me go ahead and introduce myself. My name is Garry Johnson III, and I have the distinct honor of teaching this course. And it's really exciting for me because I'm absolutely passionate about what I do. I love what I do. It is what I think about day in and day out. And the more that I learn, the more that I share. So this course is a new attempt for me of sort of packaging up all that I've learned from an investor's perspective. And again, just bringing people along for the ride, because with Bison Venture Partners, we are a firm that is built on the African proverb that says, if you want to go fast, you go alone, but if you want to go far, you go together. So A little bit about me. I am a serial entrepreneur. I worked on various different businesses and startup ideas since graduating from the University of Delaware. And all of that has given me different insights and connections and access to different resources. And I've truly developed a passion for solving problems in new and creative ways and doing things that allow me to collaborate with really cool people who just want to build a better world together. So I started this journey as an entrepreneur, then became an investor in certain companies that I've come across throughout this journey. And again, I take both my entrepreneurial experience and my investor experience, and I educate others. So I serve in a few different roles, one being that I am an adjunct professor at the University of Delaware, where I got my undergraduate degree and master's in entrepreneurship and design thinking. So UD Horn Entrepreneurship was a big, big player in my journey and helped me understand that this is all about solving problems. And I'm somebody who can't but help to see problems everywhere. And I just have to create things to try to solve them in some way or another. Now, I mentioned Bison Venture Partners. Bison Venture Partners is actually a firm that I founded alongside my classmates when I decided to go back to school in 2021 and get my MBA at the illustrious Howard University in DC. And we built a firm that really started as sort of a consulting group, where we wanted to combine our collective talents and help small businesses and technology startups get investment ready and raise the money that they need to be able to build their products, build their suite of services, and hopefully when they're successful, contribute to the success of our entire community. So Bison Venture Partners is sort of a baby, but we have been blazing our own path and building a community of other people that we call the herd. So everybody who's a part of the herd are just individuals who see the mission, see the vision, and want to go further together. Now, prior to founding Bison Venture Partners, I started a nonprofit called First Founders Inc., where I really just wanted to help early stage underrepresented founders to get access to various resources, education, helping them understand how to build a scalable startup, since I was somebody who, both in undergrad and grad school, sort of took it upon myself to travel across the country and study different entrepreneurial ecosystems. I really wanted to learn, what do places like Silicon Valley and Miami and New York and Austin, Texas do really well when it comes to providing the resources that founders need at the earliest stages, whether it's idea stage or they've just started up. What do they need to be successful, and what are those ecosystems doing to make sure that the resources, the infrastructure is in place? So I went out, I studied, and I came back to this little state called Delaware and decided to sort of take what I learned across the country and do something locally that was non-existent. And it was an early stage startup accelerator targeted to underrepresented founders, but accessible to everyone. And it was something that was it wasn't being done outside of universities. So we launched that with just 8 local entrepreneurs. I brought together a small cohort, and we would meet in a local co-working space every Saturday morning. And I would just share my knowledge on entrepreneurship, and then also invite various guests to come in and help the founders understand, again, what they need to think about when it comes to marketing, legal, growth. And then also, if they were going to be raising outside capital, we would bring in small business lenders and venture capitalists to come in and speak as well. So it was a small test. Wanted to prove something in the local community and just serve the Delaware community first. And it somewhat very quickly turned into something much larger. So since launching our initial cohort in 2019, we've scaled to now building a global community of over 300 entrepreneurs all around the world. And in regards to resources, we've built partnerships with Techstars, which is one of the world's biggest and most successful accelerator programs that invests in early stage startups. And now we're able to actually refer startups from our community to their programs and guarantee that with our referral, they'll make it to at least the first round of interviews, which is a huge deal. We've also collaborated with University of Pennsylvania, with University of Delaware, of course, Delaware Prosperity Partnership, and even Google as of last fall. And when it comes to money, we've helped our community of founders raise over $500,000 in non-dilutive funds. So all money that these entrepreneurs did not have to repay, but they could use to grow, to scale, to research, to travel, whatever they needed to do to advance their business. And then we've also helped them raise over $3 million in venture capital funding. So we have actively supported these entrepreneurs in helping them get investment capital. So not free money, but in the world of venture, to be able to build a startup that can scale and grow to a very large size, it takes investment capital, and we've helped them raise over 3 million to date. And I believe that our community will continue to grow and will help even some of the same founders we've already helped get access to more funding. So still early, but this is what I'm passionate about doing. So I have sort of 3 vehicles that I use to execute on my personal mission and vision. And with all of that, I think like a venture capitalist. So I've set these 10-year goals for myself and for my firm, which include the following. So the first is educating 10,000 new angel investors. And educating new angel investors is really important to me because since I got my start, one, being a founder myself, and then supporting other founders, I have firsthand and secondhand experience of being a founder, trying to get access to those resources and really struggling, right? But it's always the angels. It's the people who come in and help you with the resources you need to help you just go a little bit further for a little bit longer, and that makes the journey worthwhile because you know that people are out there to help you. So the reality is there are not enough people in the world actively angel investing. So it's a part of my personal and professional mission to educate new angel investors, to help everyday people understand that you can actually get in the venture space and help these founders, help these entrepreneurs grow and scale with your own capital, with your own resources, your own networks, even if you're not individually wealthy today. It doesn't take a lot of money. The next goal is sourcing $100 million of investment capital to Black-owned businesses. That's really important to me. It's really important to my community because access to capital, as I have learned, observed, experienced, is the #1 barrier to building a successful business. So if we're going to sort of reverse some of the inequities that exist in the world, we have to create equity, and investment capital is equity. So I personally believe that with what I'm doing, this is possible. $100 million in investment capital is absolutely possible. And as an investor, as someone who thinks like a VC, thinking big is how you do it. So in addition to that, I specifically want to make sure that we support 1,000 woman-owned businesses. I want to make sure that's very clear. I want to make sure that we strategically make sure that we are equitable when it comes to gender as well. And then with all of our efforts, helping to create 1,000 new jobs is a big goal. So just making sure that the companies that we support grow, they scale, and they give back to their communities in the form of hiring individuals coming from their communities. So job creation is a very important part of my mission. So one other thing that I didn't mention, one part of my education was actually being a scholarship recipient for VC University, which is a collaboration between UC Berkeley and a few different venture capital, like nonprofit venture capital initiatives. And that was a really amazing opportunity for me to be able to dive into venture capital, learn the ins and outs from people who are actively raising funds, deploying funds, people who have invested in some big name companies that are now listed on the stock market. Think of companies like Airbnb and Uber, things like that. And now to be able to take those same insights, that same strategy, package it up into our course and community here at BVP. Lastly, I'm going to dive into some startups, some different companies from my investment portfolio throughout this course. But just to call out a few, which I'm actually really excited about, Backstage Capital is actually a venture capital firm, and they were the first private investment I ever made. So making that investment officially made me into an angel investor and inspired me to learning their model and remixing it in our own way. So that is like the backstory of what inspired Bison Venture Partners. And then from there, I have actively been investing. I see deals. I laugh because I see deals all the time. And, you know, I have my own investment thesis, my own strategy, but I am an active investor, which we can definitely talk about later on. But sometimes you hear an investor say they're active. Realistically, they haven't written a check to a startup in over a year or multiple years. But for me, I just wrote a check last week. So I love what I do, and I'm always excited about new deals. One other startup I want to call out is Gumroad, which if you registered for this course, you likely registered through a platform called Gumroad, which is that same portfolio company. So what I'll be breaking down, and I'll be breaking it down as a whole case study, is investing in startups, investing in privately held businesses, and then adding value as an angel investor, right? Helping that company grow and scale by either using their platform, their resources, their tools yourself, or helping other people get onboarded to using those platforms. So I set up my sort of pre-orders and sales for this course on Gumroad, which I own a small piece of, which is pretty cool to me. And I think as anyone interested in angel investing, it is likely interesting to you as well. So that's sort of the model I want everyone who takes this course to use for themselves. Invest in companies and then help them scale by using their products, pushing their products, helping more people see the beauty that they've built. So, and then before I go to the next slide, also, I just got an email. I think it was just yesterday that I'm receiving my first dividends from Gumroad. So as we will discuss, investing is a long-term journey. Many companies that you invest in may never create a return for you, but a small percentage should. And Gumroad is one that I invested in. I believe it was 2020. So in a relatively short amount of time, now I am receiving some return, which is really great, really awesome to see, and just inspiring me to, again, you know, keep looking for great opportunities where founders can actually deliver returns for their investors. So if I can do it, you absolutely can do it. And we are going to do it together. So this course is going to run from July 3rd through July 26th. And it is a mixture of 3 different things. So on Mondays and Thursdays, I'm going to be teaching a live lecture every evening at 8 p.m. I have a time block from 8 to 10 p.m. Eastern. We absolutely can use the full 2 hours. Sometimes I may I may not need the full 2 hours to get through the whole lecture, but absolutely can stay on until 10 o'clock Eastern every evening. So sometimes we may just have a conversation. I may just be answering different questions that students may have in our community, or I may even might even bring in some different guests a little bit later down the road. So 8 p.m. Eastern is where to be every Monday and Thursday. On Wednesdays, I'm going to be hosting office hours at noon Eastern. So 12 p.m. Eastern, you can find me on this same platform from 12 to 1. And I'll just be available to answer any questions that you might have. If you just want to sort of just chop it up for a little bit, that's all good too. But you can absolutely find me here at 12 p.m. Eastern every Wednesday. And then lastly, study halls. So study halls are going to be something I'll be a little bit experimental with, in that for study hall, I actually plan on live streaming that out to Twitter, LinkedIn, and maybe even Instagram. But in study hall, it'll just be a place where we can sort of read and react to different content that is on the web. So there may be some hot topics, some news that just came out. One example of something might be Gumroad actually now paying dividends. It's like a big thing on Twitter right now. So in study hall, we can actually go through and actually review the investment materials from the Gumroad deal and see how that was structured, so that you can understand how to look for some of those things in future deals. If there's ever a time where I need to reschedule, I will absolutely let everyone know. I do not anticipate any issues arising, but sometimes life happens. So this whole course, all of the content is going to be housed in a platform that we use called Circle. So if you're tuning in on your phone, on your iPad, you may have downloaded the Circle app. You can also just view by web browser, but everything will be in the Circle app. We have the course calendar. All of the links are attached in there. Anytime a link gets updated, it'll just automatically be updated for you all there. Office hours and study hall will be the same thing. And then all of the recordings will be automatically posted to our platform. So the name of our community in Circle is BVP University. So anytime you need to look for what we've got, you can go in there. There's also a section called Study Hall that you can click on, and all of these resources will be posted in there. Different articles, different tweets, LinkedIn posts from other people who are not even affiliated with BVP, but who have put out really great content that speaks to the power of angel investing and being in this space. So if there's ever anything that you want to share with the community, you can, of course, chat with me in this platform, or leave a comment in any of the posts, and I will make sure that I get that resource uploaded as well. So again, this is a community, and we are going to have some fun together. With that being said, I do need to mention this disclaimer, which is that all of the content that I cover is for educational purposes only. Any companies I talk about or we discuss, they should not be construed as investment advice. It's not a recommendation, an endorsement of any company. It is simply to educate everyday people about how I view these opportunities, how investors view these opportunities, and how you can get involved if you so choose. You absolutely could choose not to get involved, and that is a strength of being an investor, as well as saying no. But at no point throughout this course will I ever say, here's a deal you should absolutely invest in. If I do, you can call me out. But that's not what we're here for. All right. So jumping into it now, let's talk about some key terms that new angel investors need to keep in mind. I consolidated this list, and I think in future sessions, I'll need to have multiple slides with multiple definitions. But today, I think these will cover the gist. So the first is angel investor. What is an angel investor? An angel investor, for our purposes, is anyone who invests their personal capital into privately held businesses. All right. Anyone who invests their personal capital into privately held businesses. Now, I say for our purposes because the rules and regulations, as we will discuss very soon, have very recently changed. And just 10 years ago, if you said, hey, I'm an angel investor, anybody who knew what that is going to assume that you're a multimillionaire or billionaire, because angel investing in privately held businesses, was only reserved for people who were individually wealthy or people who manage the money of those who are already individually wealthy. Thanks to the Obama administration with the Jobs Act, now investing in privately held businesses is way more accessible. So thanks to that administration, now anyone can get in on the fun. So for us, always know that anyone who's investing their own money into privately held businesses is an angel investor. So that's a mindset shift that some people are going to have to make. Regardless of how much money you're investing, whether it's $100, $500, $10,000 or more, we're all angel investors. Now, what's a startup? A startup is an early stage privately held business. All right. So for our purposes, a startup is any early stage privately held business. So a startup for us is not a company like Airbnb, because Airbnb is, well, let me use Uber. Uber is not a startup because Uber is now listed on the stock market. You can buy Uber shares and add them to your stock portfolio. Uber has gone public. Uber is no longer privately held by just the owners and their investors. Now it's anyone can invest, whether directly through the stock market or through, what do you call them? Fractional shares, even. So for pennies, you could buy a piece of Uber. So Uber is no longer a startup, but it once was. The companies we're focusing on here as angel investors are pre-IPO. They've not gone public. They're in the early stages of building out their products, their services, whether they are still ideating around what to launch, or they've just recently launched and are seeking capital to scale and acquire more market share. Those are all early stage companies. The owners of those businesses are the founders, any angel investors that they brought on board, any venture capitalists that may have invested as well. But these companies are not going to be listed on the NASDAQ. To be able to own equity in one of these companies, it's likely that you have to know the founders, or as we will discuss, you have to go through an investment platform that is regulated. Now, what is equity? Equity is an ownership stake in a business. So whenever we say equity, whenever I say pay me in equity, we mean pay us in ownership. Ownership is what this thing is all about. Ownership is a seat at the table. And ownership looks like a lot of different things. It sometimes looks like control, but when it comes to angel investing, we're really talking about minority ownership. We're not talking about any significant ownership stake that is going to give you control to change any dynamics about the business you've invested in. You are simply along for the ride. And what is the ride? Well, it's going to look a lot different because businesses operate in different industries, different markets, they're at different stages. They have different teams, different hiring strategies, marketing strategies, all those things. But before you invest in that company, they're going to offer whatever their deal terms are. So the deal terms are investment agreements between startups and their investors. So if you are interested in angel investing in a company, you'll know what you should be getting in exchange. So that doesn't mean you'll know exactly how much money you'll make, but you'll know what you've agreed upon and what the company has set out to do. So you'll know what business you're investing in. You'll know what or how much equity you'll be getting in exchange for your investment. Or if it's not an equity deal, you'll know in regards to a debt deal, you'll know how long it should take before this business starts repaying you. You'll know what any interest rates are, and you'll know what's going to happen if this company does not repay you or all of its investors. So these are really the basics here, but everyone in our community is an angel investor. We as angel investors invest in and support early stage startups. And by the way, those startups could be technology startups, building apps, building websites, building Web3 universes, but they could also be local small businesses, coffee shops, construction companies, any privately held business, real estate, even as well. For the most part, throughout this course and community, we'll talk about technology startups, but the mindset, the methods are all the same. So you can apply it to real estate deals, you can apply it to small business deals, and I will also break down ways that you can invest depending on the opportunities that are out there. You can invest in venture capital firms and organizations that invest in startups themselves. Backstage Capital being one. I'll break down that case study as well. But again, with all of these deals that you're going to be looking at, they will have investment terms that you, as the angel investor, need to review alone, I would say, first, but then seeking outside counsel, speaking to your accountant, whoever you need to speak to make sure that it is something that fits your mission, your goals, personally, financially. You want to make sure that you do that. But you as the angel investor are the one making the decision. No one else can make the decision to invest in any of these startups for you. Now, why should you even consider becoming an angel investor? The big reason, most obvious reason, is you probably want to do it for the potential of receiving very large and significant financial returns. So there's a gentleman I'll speak about in a future class by the name of Jason Calacanis. And Jason Calacanis is one of the world's most famous angel investors who invested in Uber when it was a startup. And he invested maybe $25,000. So that's a lot of money. It's very significant. But that investment, combined with the value he added as somebody who actively would share resources and his network and advice with the founder, led to the company eventually IPOing and being listed on the stock market and turning Jason Calacanis's net worth into over $100 million. All right. So a small investment into a highly scalable, high growth potential startup that ended up doing very, very well is what turned Jason Calacanis into a very wealthy individual. All right. So you may hear stories like that. There are people who get in early and then they are along for the ride, which could be anywhere from 1 year to likely more than 10 years before they see their money back, if they see any money back ever. But the rewards for angel investors can be truly that significant. It's not even possible to receive that type of return when it comes to investing in the stock market itself. So angel investors are looking for those big exits, those opportunities where their investment comes back to them in multiples. All right. So as we'll discuss, angel investors, venture capitalists, they're looking for at least a 10x return on their investment. So if they invest $1,000 into a deal, they're at least expecting 10,000. And realistically, they want much more than that. And thanks to how startups work and how they grow, they can grow over time, those returns are possible. So that's one reason you might want to become an angel. But not only that, not only the financial reason, as an angel investor, you really have the opportunity to support innovative startups, to support founders that are building solutions to everyday problems, to big problems, to important problems, to life-saving problems. Like they're life-saving solutions. They are not just sitting around and accepting life for what it is, but these are entrepreneurs that are going out and they have the audacity to believe that they can change something about the world with their creation. You have the opportunity as an angel investor to support their visions, to support their missions, whether it's, for the most part, we're talking about for-profit ventures, for-profit companies, but think about it like supporting a nonprofit. Nonprofits exist to help build a better world and make sure people get access to resources and clean water and healthcare and all these different things. Well, you donate to nonprofits, you feel good. You can invest in startups and feel good. There are founders building very important solutions that just so happen to be profit generating. All right. So that's how I view angel investing is, yes, I care about being wealthy, not just for myself as an individual, but to be able to provide the life that my family deserves, but then also to leave a legacy. And if investing in startups is what allows me to do that, then that is the most beautiful thing, because I'm already passionate about supporting these innovative entrepreneurs who are building really incredible solutions. So that may be a reason why you become an angel. The third reason might be you want to access a diverse network. I can tell you that once you get into the startup space, if you're an entrepreneur, networking is key. But once you get into the startup space as an investor, you start meeting some really interesting people who share similar passions, who maybe even see the world differently than you do, but you're able to start understanding how different people think, why people put money where they do, and how you can start expanding your worldview as well. And what you learn after you get started as an angel investor is, of course, investing alone is great. It makes you feel good. But once you start investing in startups, then you start wanting to share with your network, the people you know, the people who you think would really be interested in this particular company or the mission that it's operating in or the problem it's trying to solve. And you can collaborate with other people to help these startups get access to resources that they need. So these are just a few reasons, but if you've not already invested in your first company, you're going to want to ask yourself, why do I want to do this in the first place? From there, of course, you want to determine what your goals are. So whether it's personal or financial, I think it's important to be clear. So when I went through my background and all, I had, how much capital I want to source to entrepreneurs, how many people I want to educate, and why that's important to me. Right. So there's personal reasons and there are financial reasons. So one day I plan on managing a $100 million venture capital fund. All right. That is something I see in my future. So the companies I invest in today, ideally, will allow me to generate the revenue, the capital that potentially I'll have the funds myself, and I can deploy those funds based on my thesis. But the more likely scenario is that the companies I invest in today contribute to my track record, and then I can point to those different outcomes that I've gained over time, and then other investors in the future see this is someone who knows how to allocate capital to high growth potential companies, so I want to invest in his fund. That's part of my goal as an angel. Also supporting the community I care about. But whatever your goals are, they can absolutely be personal. They do not have to be as big as $100 million. They could entirely just be, I just want to help some founders that I know in my community, but it's up to you. From there, you're going to want to think about what is your desired commitment level. And I say that because there's sort of, I guess, two different ways to think about this. How committed you want to be as an angel. You could be passive in that you have capital, you decide to invest in a startup, and then you don't want anything to do with it. You just want to sort of give and go and wait for the return. All right. Maybe you want to invest in just one deal. You just want to invest in one company. That's a great goal. So that doesn't require a lot of commitment because you're going to find that one deal, invest, and then you've achieved your goal. You can relax, you can sit back, and you don't have to worry about finding more deals. Now, for others, you may want to be a more active and involved investor, meaning maybe you want to invest in one new deal every quarter, right? So by the end of the year, you want to have 4 deals. So you're actively looking for new deals, you're actively reviewing deals, and maybe even you want to go beyond just being an active investor. You want to be a value add investor, and you want to support these startups. You want to, maybe you join their board of directors. Maybe you support them with their marketing efforts. In some way, you open more doors for them. You help them grow. You help them scale as an angel. But that's totally up to you. So some investors are very passive in that they want to just invest their capital and let the founders do what they do. Other angels are going to invest their capital, and then they're going to be working as hard as they can to make sure that this company, one, succeeds, but at least in the near term, just has access to the resources you believe you can provide to them. All right. So with all of that, you just have to think about the impact that you want to have on the startup itself, because the reality is being a startup founder is incredibly hard. It is not for the faint of heart. And a lot of times founders are operating with little to no funds. So you as an angel, the term angel truly does live up to that. You are somebody who can come in and sort of, save this business. You can provide it with the resources it needs to get off the ground and figure things out, to experiment, to continue to even fail and learn and iterate over time and eventually figure things out to the point where, sometimes the thing that you originally invested in transforms into something different. But that transformation comes about because you, as an angel investor, were able to provide this startup with some capital to get to that point. So you want to consider those things. I think the easiest way to really keep going as an investor is to align your strategy with your passions. So maybe there's a particular industry you're passionate about, whether it's you really love healthcare, or even financial services. Maybe you care about animal well-being. There are startups, technology companies, small businesses operating in all these different spaces. So when you're able to find things that align with what you are already passionate about, it's going to be really easy for you to want to get more involved, and then to not even just invest in one company you really love, but just exploring and finding all these new ways of supporting even more people, specifically in an industry or a space that you care about. Another way to align with your passions is supporting founders that share your values. So maybe it's not even the company itself that you're investing in, it's the founder, it's the person behind the business, and you just really love who they are. You really enjoy how they see the world. They inspire you, and you just want to help however you can. And then lastly, maybe you find joy by contributing to positive change in the world. So I think for any angel investor, I highly doubt there are people who invest their capital into a business because they're like, oh, this business is really going to cause a lot of problems in the world for some people, but it's going to make me rich. I don't know that there are a lot of people that think that way. Most angel investors believe that the founders are building something that is truly going to create a positive change in the world in one way or another. So you want to think about all of those things as you get started in this journey. Of course, the most important part about being an angel is the investment capital. So you need to have money to be an angel investor. You have to invest in at least one deal to be an angel investor. You have to invest in at least one privately held business. Now, does it take a lot of money? No, it does not. But you have to think about how much you are, one, willing to lose, and then that will tell you how much you're willing to allocate to angel investing. As I mentioned, investing in startups is highly risky. You will likely invest in a portfolio of companies that the majority of them go on to either produce no returns for you or totally fail, meaning they go out of business, they're non-existent anymore, right? But a small subset of those companies are going to go on to become successful, ideally. And in the venture world, those successes make up for all of the lost companies, the lost investments. All right. But the reality is you are going to lose money in one way or another. So think about what you have today. With the platforms we're going to discuss throughout this course, with the regulations that exist today, many investment opportunities are accessible for as little as $100. I've even seen some as low as $50 on certain platforms. But $100, it could be a lot to you today. So you have to think about what your financial situation is today and how much of your savings, how much of your paycheck you're willing to allocate to being an angel investor. So since some deals are accessible at $100, which, $100 in reality is not a lot of money. If you have a job, you're going to make that back in no time. But of course, you have to live. You have to pay for food. You have to pay for rent. I understand all of that. So at the end of the day, if you're living paycheck to paycheck, $100 could be very significant. All right. So with that, maybe you only want to invest in one startup a year at $100 because you can't afford to lose $100 5 or 10 times over the course of a year. All right. So you have to think about what you have. Maybe you have significant savings. Maybe you have, some disposable income. And you really want to get into the space, and you decide, you know what, I'm going to allocate maybe 5% of my annual salary, 5% of your net worth, however you want to calculate it. You decide, I'm going to allocate this percentage, which is small in relation to all of the money that you'll make throughout the year. And you want to allocate that small percentage to investing in some risky startups that you have decided actually have high growth potential and could create a significant return on investment that you are comfortable with. So that decision is for you to think about, but it's going to require your money. It's going to require your time, your energy. So think about how much you want to put in. Do you want to be a passive angel that only invests in deals when somebody sends you something and it comes with, a significant referral? Or do you want to be somebody who you do your own deal sourcing? You're the one that's going out. You're going to events. You're going on all the investment platforms and you're reviewing various deals that are out there. That's its own level of commitment. That definitely takes time and energy. And then when you find a deal that you like, it's going to require your capital. So thankfully, like I mentioned, there are deals that are accessible at as little as $100 per investment. So in reality, as an angel, you want to think about getting started without a lot of risk. You don't want to see you don't want to invest, thousands of dollars into your first deal. You want to make some small bets here and there to get started, get a feel for it. And then as you learn over time, you'll build your thesis, as we'll discuss. And deals will always be out there. Deals will always be coming at you. Once you get started investing, you will see that there's FOMO, fear of missing out on certain deals, just because of all the hype surrounding it, or other co-investors who are in on the deal, or whatever it might be. But more deals will come. Startups will always need money. Startups will always be raising. And you don't want to get to a point where you invest in one or two deals and then that was your whole allocation. That was all of your angel money invested into those deals. And then you see a third deal and you don't have the funds to be able to invest because you sort of invested too quick in those other deals. You'll learn very quickly that deals are popping up every day, and it's really a slow and steady journey. So with that, it's also important not to stop yourself at thinking about your money, but think also about what expertise do you have that you could share with this startup? Could you help them with marketing? Could you help them with legal? Could you help them with connecting with other potential investors? What connections do you have? What knowledge do you have that you can share with this company that, again, will hopefully multiply your investment over time? Another term that is not typically used with angel investing, it's typically used with venture capital investing, but for our purposes, these are interchangeable. Your investment thesis is going to be your focus area. So for a lot of venture capital firms that go and raise other people's money and then invest that money into startups, these venture capital firms develop a thesis that lets their investors know we are going to be looking for these types of companies. We specifically invest in these types of startups and nothing else. So for you as an individual, you may want to start drafting your own investment thesis, right? Like just your statement on, I want to invest in companies that are specifically in this sector or industry, or maybe this geography, whether it's, US based companies. It could be companies on the East Coast. It could be companies on the West Coast, Midwest, down South. Or maybe you want to focus on investing in Africa. You want to invest in Nigerian startups, right? You want to invest in, there are companies all around the world, companies in the UK. And depending on your network, the types of deals you're able to see, you can gain access to these different types of startups. Maybe you're someone who's really passionate about making sure that there's gender parity when it comes to access to capital. So, you see the statistics around, I think it's between 20 and I think women founders receive between 20 and 30% of all VC money that's invested in privately held businesses. And you want to help them get closer to 50%, right? Maybe your thesis is, I specifically invest in, woman-owned businesses, women-founded companies. That could be a part of your strategy. Absolutely. It could be anything. For me, being a Black American, it's important for me to invest in other founders who I relate to culturally, right? And for clarity, I invest in all types of founders, but being a Black founder, I have my own experiences. I know what it's like. And a lot of times I can relate to founders in ways that other angel investors and other venture capitalists cannot. And that's a part of my value add. So that's important for my thesis. All right. But whatever the deal is, you're going to want to lean on your thesis so that you can also determine, does this deal fit in with the portfolio I want to build? Because in a future class, we're going to talk about how investing in one startup is not a winning strategy. You want to build a diversified portfolio. Whether if you're in stocks, maybe you already know that, but you should not put all of your eggs in one basket. You shouldn't invest in one startup and think, yep, this is going to be my Uber and I'm going to ride off into the sunset on this one and I will be good. That's not how it works. You're going to need to see really, a lot of different deals, and you're going to have to build your own evaluation criteria that you can lean on to make sure that you, one, do your own research, but also are investing in what you've deemed to be appropriate, relevant, and important to you. Just a few more slides in this section, but you want to think about how you want to evaluate risk and return. With every one of these investments, there's a risk reward trade-off. The risk is high. The statistics say that more than 90% of startups are going to fail in one way or another, right? But that means that 10% are going to win and succeed. So when you get started as an investor, you have to know you're going to lose money. You're going to lose money. Anybody who teaches you about investing, who says, yep, I'm going to teach you how to invest in companies, and these companies are only going to be profitable, they're only going to be successful, I would not listen to that person. Investing comes with risk. Risk means these companies can fail. They will fail, but some will win. And hopefully together, we're doing our research and sort of figuring out which signs and signals point to which companies are more likely to succeed. But failure isn't always the founder's fault. You want to think about how high and how large this company can actually grow and scale, right? How much market share it can even capture. Even if it had all the money in the world, how big of a business could this be? But then things outside of everyone's control include market conditions. You know, a recession could come, a depression could come, a pandemic, a lot of different things. A hurricane could come and destroy someone's office, and now that business is out of business because all of their stuff is gone. Data breaches, hacking, all these different things can happen. Even if you see the greatest business in the world, things can happen. There's risk with every company, every investment opportunity. But again, hopefully you are in it for the long haul. Hopefully you are in it for more than just the financial returns. You're in it for the joy of being along the journey. And with that, you should be more comfortable with the risk return. And then lastly, you want to come back to your why. You always want to think about why you got started, because I can tell you before the Gumroad update that I mentioned, being notified that I'm receiving dividends for my investment, I actually had a company say that they put out a message to all of their investors, and they said, "Hey, we are shutting down for various reasons." Right? And that was, you don't want to hear that. It's not something you're proud of, but it absolutely comes with the territory. And the only thing that's going to keep you going when you get those failures is thinking about, why did you get started? Did this company perform? Like, did it at least attempt to achieve its mission? If so, it probably put up the good fight and you helped it do so. All right. But staying true to your purpose, to your values, that's what's going to allow you to sleep at night. Like, you know what? I enjoy this. I'm helping in ways that make me feel proud, make me feel fulfilled, and I want to continue along with this journey. So, along the journey, you're going to refine your strategy. You're going to learn a lot. You're not going to invest in every deal that you see. For me, I was like, I need to invest in this one and that one and this one and that one, just to build a portfolio that was a little bit diversified across industries and hopefully would give me some more clout within certain spaces. But then you start to see that, what's going to really keep you going is investing in the companies that speak to you and align with your mission and value. So with that, I'm going to pause and take a little break. The second part here, I'm going to talk about the rules and regulations you need to know before you get started investing. So that's really important, because in our future lessons, we're actually going to be looking at different deals, and depending on where you fit on this spectrum, that will determine sort of how you can get involved angel investing. So with that, if you're tuning in live, please feel free to drop me a note, drop any questions if you have a question about anything I've covered. But if not, we will resume at 9:10 p.m. Eastern. So 6-minute break. All right. So John Carlos, I see your question. So your question is, how much risk do you assume as an angel? Should this be done under an LLC? These are both great questions. Okay, so first question first. How much risk do you assume as an angel? The first and biggest risk is going to be, of course, the capital that you put in, right? You risk losing all of your capital. Now, if your question is sort of around if I invest in a company and let's say the company does something illegal, am I somehow like liable? Am I, affected? Am I going to be held responsible? I think so. Of course, I'm not a lawyer, an attorney, anything like that. So I would speak to an expert in that field. But for the majority of deals that definitely we're going to be talking about, and even the majority of deals that angels get involved in, there's no personal risk outside of losing your capital. You as an individual are not going to be sued. You're not going to be held responsible for any damages that the company creates. But if you do want an extra layer of just protection as an individual, you may and you can invest under an LLC. So I actually do. I prefer to invest through my business. And I actually have multiple businesses. So depending on the investment, depending on the size and different things like that, I may use a different business, but I prefer to use my LLC. For one, tax reasons, really not protection reasons, because in no deal outside of owning my own business am I a majority owner. Angel investors, when we're talking about investing small amounts, and by small I mean this is typically anything between $100 and probably even 50,000. The equity stake is not significant. So I guess it sort of depends on the deal. I would say use an LLC. That's what I personally do. But I would consult any expert that you feel is appropriate. And John Carlos, let me know if you need further clarity. Also, can you help me understand the second part? Non-investment capital risk, personal legal risk. Oh, okay. I think I did touch on that. So yeah, so if the company fails, if the company goes into debt, if the company goes bankrupt, you are not going bankrupt, right? Like the business, the company you invested in is bankrupt. So yeah, thank you. It's actually a really great question. I'm glad that you asked that. So yeah, and then also, depending on what your longer term goals are, like I said, like my company, Bison Venture Partners. So we actually write small checks through the business, and that allows Bison Venture Partners itself to have the track record that is going to hopefully one day allow us to raise even more capital. If I invested in certain deals personally, I can't necessarily use the same track record depending on the type of investment capital my firm is looking to raise. So it's strategic. There's more considerations if you're investing for like longer term goals to raise your own fund or things like that. But I definitely started investing my personal funds, and then started using my business to invest. And there's actually, so something cool with the Gumroad example is that I invested my personal funds back in 2020, I think it was. And then now that I'm receiving dividends, I'm actually I'm having the dividends pay my business. And of course, that has its own tax implications. But my business raised outside capital. So now I'm able to use a personal investment I made even before my business existed to now, I founded my own business. I own it 100%. And I'm able to use, these dividend payments to now contribute to operating the business. And part of that means repaying our investors. So it's a little bit of a layered thing, layered strategy for me. But it's totally up to you. Investing your own personal capital as an individual is fine, but of course, you want to assess what the tax implications will be for you and what your longer term goals are. Awesome. Great question. And I will be sure to actually, as we'll discuss, there are different platforms you can use. If you do decide to use your LLC for investing, the platforms we'll talk about are depending on your accreditation, are either regulated or not regulated. So if it's a regulated platform, most likely they do allow you to invest through your business, but you have to verify that you in fact own the business. So on a platform like WeFunder or Republic, you just have to upload your formation documents, operating agreement, maybe EIN and different things like that. So you have to prove that you own the business. But so long as you have those documents and all, it's no problem. But as we will discuss now in the second part, you'll see that the investment limits, depending on accreditation, are going to be the same whether you're investing individually or through your business. Yes, interesting. It is interesting. All right, so let's go ahead and jump into it. So the second part here is now know the rules and regulations. So regulations exist to protect investors from fraud and illegal investment activities. So there is a government agency, I guess, or commission. It's called the Securities and Exchange Commission. That is a federal agency that ensures everyone abides by the rules. So they don't set the rules. Congress, the president, they set the rules, but the SEC regulates the rules. They make sure people are following the rules. So breaking the rules would be non-compliant and can result in fines and, potentially fines and potentially jail time. So knowing the rules is important. Abiding by the rules is important. And it is a very interesting space to be in because the rules are actively changing. I mentioned new laws such as the Jobs Act that allowed for everyday people to start investing in privately held businesses. So some rules that exist now may not exist in the near future. Some rules that exist now could get even more harsh over the years ahead. But all in all, the SEC is this government agency that is making sure that startup companies, businesses that are raising investor money are not doing illegal things with that investment money. And they are the ones who will then determine who may be getting jail time because they defrauded their investors or they were not compliant. XYZ reason. I find the rules interesting and a little bit discriminatory because the SEC exists to protect investors, but what it has sort of created is what boils down to classism. So to break that down, what's essentially been created are two classes of investors. You have accredited investors, and then you have non-accredited investors. So as an angel investor, you are going to fit one of two boxes. So first, let's start with what is an accredited investor. Accredited investors are wealthy individuals allowed to invest in privately held companies. These are people who've been able to invest in these companies before the Jobs Act and have no limits on their investment capabilities whatsoever. They see a company they want to invest in, they are able to invest their money however much they want. So these are typically wealthy individuals who've earned, a high amount of income or have inherited wealth through whether it's, cash in the bank or various assets. But when it comes to income, to be deemed an accredited investor, you have to have generated at least $200,000 in income last year, over the past 2 years, actually, and reasonably expect to generate the same next year. So that takes out pretty much everybody with like a regular full-time job. Even if you're making six figures, and typically when you say six figures, you think 100,000, that rules that person out, right? You're not an accredited investor, even if you make $150,000. If you make $199,000 a year, you have not meet the threshold to be an accredited investor. So that's the first bar. The first bar is $200,000 a year in income, either jointly or with a spouse is actually more than 200,000. I think it's 350 with a spouse. So that's a pretty high threshold there. If you don't meet that, you have to at least have a net worth over $1 million, excluding your primary residence. So if you just happen to, be a millionaire, then you're accredited. Absolutely. You're good to go. So before I get to the last part, what I think is very interesting about this is that neither of the first two requirements involve being good with money, being smart with money. It just means that either you were born into wealth, inherited wealth, or you have a very high paying job, right? So interesting. The other way to become an accredited investor is to actually hold certain professional certifications or credentials. So there are different exams that certain financial professionals may have to take, like investment professionals, people that are like wealth managers and things like that. You may hold a certification because of the work that you do at your company, at your job, whatever it is. If you hold one of those certifications, then that deems you an accredited investor. But for other people, you didn't have to take a 150 question test on securities laws and all the, not even just fundamentals, but doing deep dives into different deals and scenarios. You don't have to be a good investor to be deemed an accredited investor. It's just a qualification, really a title that the SEC has come up with and they have given to people that fit this criteria. So I do want to make that part clear. Being an accredited investor does not mean you're a good investor. It doesn't even mean that you've ever invested in a business before. It's just that so long as you meet this threshold in one way or another, you are deemed accredited and therefore allowed to invest in privately held businesses. So that's interesting. There are also individuals who are accredited investors. They meet that criteria, but they don't even know it. Once you get into the startup space, you start to see that depending on where you are, like if you're in San Francisco, Silicon Valley, people out there, they see deals all the time. It's a startup hub. It's a startup ecosystem that thrives out there. So many people know if they're accredited because one, they probably make a lot of money, and then two, they actively see investment opportunities, and they know that a lot of successful startup companies have come from Silicon Valley because of the funding that's available. But if you go to somewhere like the state of Delaware, you may find that, yes, there are wealthy people that live in Delaware, but they don't actively invest in startup companies. So they are technically accredited investors, but they don't actively invest in startups. So just an interesting observation. Now, on the other end is going to be non-accredited investors. Non-accredited investors can also invest in startups, privately held businesses, but non-accredited investors it's everyone who does not fit the previous criteria. So you don't make over $200,000 a year by yourself, or over $350,000 combined with your spouse. You don't have $1 million or more in net worth. You don't have a certification such as your Series 7. There's a bunch of different numbers. You can pick a number. There's probably a test for that number. But if you don't have any of those certifications, then you are deemed a non-accredited investor. Now, does it mean you're not smart? No. Does it mean you're not financially capable to invest in startups? Does it mean you can't afford the risk of losing whatever allocation you want to make to a startup? No, it does not. There are people who actively invest in stocks, in now startups too, that are not accredited. And they're way smarter than people who may be accredited, right? It's just a classification that the SEC has come up with because they exist to protect investors, and they believe that it is necessary to further protect, let's call non-accredited investors, everyday people. They want to protect everyday people from losing their life savings. That's sort of how it's typically discussed, is like, this person's not accredited. They don't have $1 million in the bank. They can't invest in a startup. That startup's going to ruin them financially if it fails. Well, again, if you are someone who's doing your own research and not investing more than you're willing to lose, you'll be fine, right? There are no rules about, or as far as I know, I don't know what rules exist about the stock market, how much you're able to invest in stocks within a year, how much money you're able to gamble at the casino, how much you're able to spend on lottery tickets, which a lottery ticket I would say is much more risky than investing in a startup. There aren't the same limits when it comes to that. So either way, these are the rules, these are the regulations. They are actively being petitioned to change. The Jobs Act changed because communities said, hey, businesses need money, and hey, we individuals in the community have money, but we can't invest in these companies because there are rules saying we are not allowed to. So rules are changing, but today there are accredited and non-accredited investors. And the only way to get accredited, again, is to either be a millionaire, make a bunch of money in a year, or hold certain certifications. By the way, those certifications are not tests that you can just go online and register for. You have to work at most likely a financial institution. Then that financial institution has to essentially co-sign you to be able to take that exam. And I'm not sure how the fees and all work if you pay for it yourself, if the company reimburses you. But that is how you become an accredited investor. The majority, it's probably more than 80% of Americans are non-accredited investors. And these are all people who were barred from investing in privately held businesses, the same businesses that if they choose the right ones, if they build the right portfolio, these investments could turn non-accredited investors into accredited investors, but you're literally faced with certain barriers that we'll discuss shortly. Either way, both accredited and non-accredited investors are angel investors today. If you invest in a company, however much you invest, you are an angel. I want that to be very clear. So to dive deeper into the non-accredited, because I believe the majority of our community at BVP consists of non-accredited individuals. Non-accredited investors typically have to rely on crowdfunding opportunities. And crowdfunding historically has gotten a bad rep. But the reality is accredited investors rely on crowdfunding as well. So it's just a very interesting dynamic. But how investing works in general is startups can either raise the capital that they need directly from angel investors. So if there were an accredited investor who said, I want to invest in this new financial technology app that, this freshman at the local college is building. If they want to invest $25,000 into that startup, that accredited investor can invest their $25,000 and directly be on what's called the cap table, a list of all the investors in that business. A non-accredited investor cannot do the same thing. For one, they can't invest that much money. They're not allowed to. But they also can only invest in privately held businesses through crowdfunding platforms and portals that are regulated by the SEC. So if you're a non-accredited investor, you have to rely on investing in deals that are active on one of these portals. In addition to that, the SEC limits the amount a non-accredited investor can invest in any given year. I'll speak to that first. So the limit for non-accredited investors is actually $2,500. So if you are non-accredited and make less than $125,000 a year, your maximum amount of money you can invest, you can angel invest in a company through one of those portals, is going to be $2,500. And that's not $2,500 per deal. It's $2,500 total per year. So think of it this way. If you make $125,000 a year or less, which most people do, you can only invest $2,500 into your entire portfolio. So let's say you want to invest in 10 companies this year. Your budget is $2,500 if you make less than $125. All right. So that's the threshold. As we'll talk about in future classes, You want to build a portfolio. That's the only way to win. You have to have multiple startups in your portfolio. And with a $2,500 budget, depending on the deal, you may only be able to invest in, let's say, 10 deals max, but maybe 5 deals, depending on your budget. So when we think about the US in particular, and we think about wealth building, it's hard. It's hard for someone to get from being a non-accredited investor and then living the American dream in the sense of Jason Calacanis, investing in an American company that goes on to change the world and do financially incredible. You can't have that experience, right? As the laws exist today, it's very hard, at least, to have that type of experience. So this is why there's a lot going on in DC. I won't get political in the course, but people like myself, people like others that I study and learn from, more so them than me, but we're all trying to do our part to making sure that more people can, one, get in and be a part of the venture space, but then also we can hopefully influence the laws to make it more equitable so that everyday people can actually rise up and sort of, grow from where you are today. And the sort of metaphor I would use is like climbing the corporate ladder. It's like when it comes to investing, you can't really climb as the laws exist today. It's very hard to do so, at least. So today, those are the rules. There are ways that we all sort of maneuver, but that is what it is today. So when it comes to investment platforms for non-accredited investors, think about platforms like WeFunder.com, Republic.com, StartEngine.com. These are like big investment crowdfunding platforms. I have a whole lecture. I'm going to break down each platform. I'll tell you where to look, where to find the different information, how to review the deals listed there. But these are the big ones. And as a disclosure, I actually am an investor in WeFunder, Republic, and StartEngine, proudly. And part of my strategy as an angel investor is not just directly investing into startups that may be raising on those platforms, but investing in the platforms themselves, because one, it enables this whole ecosystem to work. These platforms do. But then also you can kind of think of it as, hey, well, if these platforms are helping founders raise hundreds of millions of dollars a year, I can financially benefit from that platform that enables the whole ecosystem to work. So again, I'll sort of break down how that looks and actually break down some of these deals themselves. But these are sort of the tools you have available to you if you are a non-accredited investor. If you're an accredited investor, you can also invest in these platforms, on these platforms. Just because a company is raising on one of these platforms does not mean it's not a quality investment opportunity. Times are changing, and when investment crowdfunding just came out, it was sort of like frowned upon, and people who are VCs and things would sort of just like disregard and just sort of write off anything crowdfunding related. But now we're seeing companies that are doing incredible and have already raised venture capital money, also then raising on investment crowdfunding platforms like these and allowing their customers to become investors, allowing more everyday people to become investors. So times are changing, which is great. That's why I think it's important to teach this course and be a part of this sort of time in history, because high quality deals are coming through these platforms all the time. It used to be thought that, oh, if a company's raising on a crowdfunding platform, that means that it can't raise VC money because it's not a good business and it's not going to go anywhere. But times are changing and people are seeing that, one, actually crowdfunding is a great strategy for startups, especially if you raise from your customers, because they're even more bought into this long-term journey. They want to see you win. And if they already love you and you allow them to get in and have an ownership stake, it just powers the platform even more. In addition to that, I mean, there are certain companies that just struggle to raise venture capital money and have to crowdfund. That's absolutely the case, but it doesn't mean that they can't be successful. It just means venture capitalists didn't see them as valuable. But the majority of investments that venture capitalists make fail anyway. So why should you rely on them to pick winners? So with that, let's keep on pushing. So something to keep in mind, the SEC will say that you have a $2,500 limit per year to invest across your whole portfolio. If you make less than $125,000 a year, that's also across platforms. So these platforms rely on you, if you're non-accredited, to self-certify that you are not exceeding your investment limit. So if you are accredited, there are additional steps that you can take to actually verify that you're accredited, and then the platform will remove your limit on your account. But if you're non-accredited, the platform should not allow you to invest more than $2,500 within a year. It keeps track of all that stuff. So where it gets tricky is if you invest $2,500 in several deals on just WeFunder.com. Let's say you did that this month. Let's say you did that today. Tomorrow, you can go on Republic and invest. If you have, an additional $2,500 you want to invest, you can do so. Every platform has $2,500 as the limit by default. So it's up to you as the investor to manage your limit across platforms. It's not clear. Like, I've not found anyone who knows. I've not been able to find anything online. But, the question is, and we talk about this stuff on Twitter too, what happens if someone exceeds their limit? And we don't know. No one knows. I'm sure it happens all the time, actually, but you don't want to find out, right? It's not the type of thing where you're like, yeah, let me gamble and see what happens. But the SEC has these regulations and guidelines, but there's not, to my knowledge, someone who goes into your, who's going to review you. The IRS isn't going to review your tax returns and see, oh, you invested, $5,000 this year, but you make, less than $100,000 a year. So you shouldn't have been able to do that. It just doesn't work that way. So the rules and regulations are a little bit weird in that way. But I say all this to say that you, as the angel investor, if you're non-accredited, you really have to manage your own portfolio to know where you're stacking up when it comes to your investment limit for the year. What I didn't mention is that if you are an accredited investor, you can use other platforms, which are really also crowdfunding platforms, but only for accredited investors. Platforms like AngelList allow startups to raise from angels and VCs. It's really, yeah, exactly. John Carlos said, crazy how I can trade options with margin, but can't invest more than 2,500. Yeah. So it doesn't make sense is all I can say. Like, it doesn't make sense. And you would think that the SEC knows that, but to be honest, part of it, again, is classism. Part of the whole venture ecosystem is like, hey, a lot of people in this space have made a lot of money because they already had access to money and then therefore they were allowed to invest in these high growth deals that just exponentially grew their wealth, right? There were people who invested $5,000 into Uber very early on, and I'll find the numbers, but the return on that was very significant. So, now rules have changed a little bit, and more of us can get in. So it's important, again, to one, educate people so that you can hopefully find an Uber on an investment platform, or something we can discuss in office hours or study hall is actually how to get on a cap table without investing money. There's something called advisory shares that you can, if you advise a startup, help mentor a startup in a significant way, that startup may offer you equity in exchange for just your knowledge, your expertise, your connections. So that's a way to have an ownership stake here as well. And I actually have a really great story about that. So there are ways, there are ways around it, but unfortunately, these are the rules as they exist today and what most people have to abide by. Last point I will say is, just because someone's accredited and they invest in startups does not mean their startup investment is more successful or could be more successful than yours. It's the same rules, same risk, just different rules now based on how much money you have in the bank. As I mentioned, we don't know what the limit or what the penalties are for exceeding limits that the SEC has set out. But it's if you break the rules, it's your fault because once you get started, you will clearly know the rules. All the platforms are regulated by the SEC, so there are all types of disclosures, disclaimers, when you go to invest in a company, when you create an account, all these different things. So you'll know what you're getting into. And, if you're listening to me, now you know the rules. You can't say you didn't. So sorry. But this last point actually is also incredibly important. If you exceed limits, that could result in the inability to finalize certain investments. So if you want to get in on a deal that you're really excited about, maybe you can't because you weren't paying attention to your limit. You went over it over time. And now this deal that you're like, this is the one, like I really, really wanted to be in on. I've been building my portfolio over time, but this one just popped up today and I see it's going to, like sell out fast. They're about to raise all their money to hit their goal. I want to get in. Like, you can't get in. There's no way to get in because you exceeded your limit already. So that, again, is why it's important to keep track of where you are with your limit, and always make sure you have more room to be able to get in on a deal if it just happens to pop up and it's something that you really, really at least want to put $100 into. All right. With that, so that is my final slide tonight. If you have any other questions, please let me know in the chat. But this was really the foundation. These are sort of the fundamentals. But I'm going to get into more examples. We're going to review some deals. We're going to talk about how to analyze a deal, how to do your own due diligence, as well as I'm actually curious to know if you've made an investment or not. If you've made your first angel investment, put a Y in the chat. If you haven't, put an N. And by the end of this course, hopefully you at least have found a deal that you're interested in pursuing. You don't necessarily have to invest in it, but we will review deals. I will give you the tools to find deals on your own. And if you do want to make your first small investment, you absolutely could. So that'll be great. And I'm looking forward to that. Lastly, I'll say, if you happen to find a deal, even before the end of the course, just drop it in our community chat. Drop it in the questions and answers section, or even send me a direct message. And I would actually love to review it before class and be able to, sort of add it into the slides and chop it up with everyone. But hopefully you found value in this. And if you didn't, let me know, because feedback is a gift. But if you did, let me know, because feedback is a gift. And I love Christmas. But I'm looking forward to continuing along this journey with everyone. This is really just the beginning. And I look forward to seeing you all in class, hopefully live again. I will see you on Thursday. All right. Have a great night. Have a great day. And I will see you soon. All right. See you, John Carlos. Appreciate you.